So what is the big lesson that you think Europe needs to learn from the GameStop phenomenon?
Good morning, Anna. And I think you posed the situation very clearly. It's about a lesson learned for Europe, because at this stage, it is mainly a development in the US. There's been some impact on individual issuers in the EU, but clearly this is mainly so far a US phenomenon. And I think the lessons learned here, for example, relate to risks for investors, retail investors. What we have seen, and we also see that in Europe, is that there is bigger participation during the COVID-19 crisis by retail investors. But obviously there is risks in getting your advice from social media, and you can question how that fits into, let's say, a plan to save for the future. We've always supported a bigger participation by retail investors in the capital markets, but obviously they should do that prudently.
Yes, I mean, do you sense then that new regulations could be required in Europe?
Well, not so much. I think this is really about applying existing requirements to the situation. As I just said, we have concerns around retail investors basing their buying behavior on inputs from social media. It's important that you get reliable information. But there are also risks, for example, around for retail investors, that they don't violate rules on the market abuse requirements. Obviously, you should not give manipulation or misleading signals around prices on supply and demand in shares. And so retail investors need to be careful there is how they participate in social media and what their messages are in that respect.
Yeah, what is the dividing line in your mind, Stephen, between simple, innocent comments on social media about a company and manipulation? Have you learned more in this recent episode about where that dividing line sits?
Well, you know, as we typically say, the market abuse requirements are complex. Obviously, if you say that you're interested in a stock and you're interested in buying it, and we know that there's been especially an interest in those stocks in the US where there were very high short positions, and that in itself is expressing a buying intention is not doesn't create risks in terms of market abuse requirements. The real risk is around giving misleading signals around pricing, trying to coordinate that also with other retail investors. Another point I think that we need to look into, looking at the GameStop case, is around the fact that also technology, online brokers with zero commissions played an important role in this case. We've always been in favor of trying to lower the cost of investing. We know that in the longer term is that the cost of transactions, etc., the impact the longer term performance of financial products. But we have concerns here around the payments for order flows. And so the relevant brokers, of course, can get payments. We know that that is happening for how they direct their order flows, and that raises questions around putting the interest of clients first.
OK, and do you see positives? Have you seen positives? We've talked a lot about the concerns, Stephen, but do you see positives around increasing engagement from retail investors with capital markets in Europe? Is that something that you can see the positives in that as well as the negatives?
Absolutely. No, that is a positive. One of the things where Europe should really work on is increasing the role of capital markets in the household savings of households across Europe. Despite the negative interest rates, we can see that there is still a tendency in European families is to save through deposits. And obviously, that is a very difficult financial planning strategy if you want to get, you save for the future, save for educational expenses, for housing, for retirement. And so the fact what we have seen, and that is not only in the US but also in Europe, a bigger role of the capital markets in household finances since the COVID-19 crisis. Apparently, people have more time to invest. That in itself is a beneficial development. At the same time, you would hope that households are really doing that for the longer term, and you can question how the participation in such cases as GameStop, how that fit into a longer-term financial plan of a household. Again, we have seen a limited number of European investors stepping into these stocks, and then separately from that, there's been few stocks in the EU have been affected. Interestingly, of course, is that the short-selling positions had an important role here. There's more transparency in Europe around short positions. What we have seen in the EU is a reduction of these short positions, the ones that are reported, and I think possibly as a reaction to what we have seen in the US.
Can I just get your thoughts on something else, Stephen, while we have you, and that is around the Brexit conversations. A memorandum of understanding is being sought between the UK and the EU now, I understand, on financial services by March, which is not very far off now. What kind of expectation around equivalence and the timetable should we have?
I think it's important to realize, and this is first and foremost, it is a political negotiation, and it is for the European Commission to give their information on this process. Obviously, what the key issue here is to what extent do we, from a European perspective, have sufficient assurance about where the regulatory and supervisory system goes, in which direction will it go in the UK. And it's important to point out how substantive that is for Europe. In the past 5 to 10 years, Europe has worked very hard on trying to reduce differences among the member states in terms of supervision, in terms of regulatory requirements. We have moved from the so-called directives to regulations, precisely because we know is that differences in rules, differences in supervision can impact risks, they can impact a level playing field, and therefore I would assume that the Commission will especially focus on that point where more information, more assurance regarding where the UK regulatory system will go, in which direction, where will be the changes.
Yes, I mean, some would suggest that it might be a bit unreasonable to try and bind future UK administrations, Stephen, and that maybe you have to make equivalence decisions, or they might suggest you make equivalence decisions based on the reality and whether equivalence exists today, rather than things that might or might not happen in the future.
I understand that, and I also understand that with the UK out is that they want to have their sovereignty around making the rules. But from a European perspective, there is the real and substantive issue, is that there will be problems in terms of risk. There will be problems in terms of a level playing field if you give access to an internal market by a system which has different rules, different supervision, and so that makes it indeed very difficult to progress here.